Welcome back to K-Ratio's Weekend Preview. I'm Kyle Lintner and I'm here today to provide actionable insight for the future, not recap the past. In this week's episode, Thanksgiving has come and gone, but left behind a new record for tender volumes and rejections. We'll break down what that means for you this week, but first let's take a look at where the freight market currently stands. Well, hello, 17,000. The National Outbound Tender Volume Index popped its pretty little head just above that mark to hit a new all-time high of 17,079 on the day before Thanksgiving. This was a broad-based surge in tenders, as all major markets like LA, Chicago, Dallas, Atlanta, and Harrisburg all equaled or exceeded previous highs. Even more shocking is the post-holiday number of 12,761, good for 49% higher than last year, seen in green, and 56% higher than 2018 in orange. With fresh new records in tenders often comes records in rejections, and last week was no different. 28.46% is your new all-time high for the National Outbound Tender Rejection Index, but the most impressive feat of last week was the fact that every single day of it saw rejections above 28%. Since first topping 28% on November 20th, the National OTRI has yet to drop below it. Record tenders and record rejections typically mean record rates, and while not quite, we are in the neighborhood. As reported by Truckstop, last week's delayed print of $2.91 per mile on November 22nd, which is 3 days shy of the record OTVI and 5 days before the record OTRI, is an increase of 3 cents from last week and only 4 cents off the all-time high. Furthermore, it's now been 12 consecutive weeks above $2.80 a mile, and this elevated rate situation is not ending anytime soon. The reason behind that proclamation is another dramatic twist in the unique relationship between spot and contract rates, as only the freight industry can produce and tolerate, but that's another story. Our favorite chart from DAT depicting the two shows that after narrowing to 10 cents to close out October, the spread has again widened, now out to 13 cents as spot rates hit a new high of $2.45 a mile. Much is made about volume metrics in this industry, and rightfully so. We all want to get a sense of how much business is being conducted, but it's that measurement of conducted business where opinions begin to differ. Without going too far down the rabbit hole of total dollars spent, ton miles, or loads, I wanted to highlight one interesting aspect of freight in general and of this relentlessly bullish market in particular. This dual-axis chart displays the National Outbound Tender Volume Index in blue and the National Outbound Tender Reject Index in red. One quick preface: a singular load can be tendered more than one time, think routing guides, so the OTVI is not a measure of absolute volume. That doesn't diminish its value, however, as more total tenders signifies a lack of capacity and or rates priced too low, and it tends to move in correlation with the OTRI. Like mentioned earlier, the National OTRI spent all week above 28%, which means the accepted rate of tender spent all week around 72%, and when that is multiplied by the OTVI, it gives us an index of accepted tenders. Now to the point. The beginning of the week was strong with an accepted tender index of 11,629, a top 10 all-time reading. The peak gave us a 5% increase from that to 12,262, and the drop-off came in at 9,162. There were more accepted tenders on November 25th than total tenders for any day in 2018 or 2019, and the level of accepted tenders after the holiday drop-off was 13% higher than total tenders at this point last year. No matter which volume metric you want to follow, there is an overwhelming amount of freight moving throughout the country right now, and certainly much more than the current supply of trucks can handle. What does this mean for freight this week? Carriers, it started out west, made its way to the Midwest, and now you can get paid all along the East Coast. In fact, only one of the 135 markets has tender rejections less than 10%. That is if you don't round up from 9.6, and you can find it in Bismarck, North Dakota. If you can make your way to the major volume market of Harrisburg, you'll find a load to Atlanta that jumped 30 cents from last week to now stand at $2.52 a mile, and your options for loads in Atlanta are superfluous as tender volumes there jumped 10% from last week. Brokers, we mentioned it earlier, national tender rejections at 28% despite the volume pullback from the holiday, if you want to call that a pullback. All of this to say, take your options early because the waiting game is not tilted in your favor, and in some markets your options for capacity might literally run out. Shippers, quit pushing your loads out. You don't like when your providers cancel on you, then odds are nobody's dying to take your load that pays $600 under current market value. The situation is not going to be any better this week or certainly the next. So just get the loads out the door. For all of you, capacity is typically slow to return after a holiday, and this is a bad thing considering the massive amount of volume going on. Add to that, online holiday shopping is so far 22% higher year over year, which means this week will be another record of tenders, rejections, and spot rates. To stay current with everything freight, follow us on LinkedIn, or for more information on all of our product offerings, including our award-winning freight intelligence platform so your margins don't end up where they are today, check us out at k-ratio.com. Please stay safe, and thank you all for watching.